Welcome to Intelligent Investor Insights with Joshua Barone and Robert Barone, your co-hosts and guides through the noise of today's markets. Here, we interpret the data behind the headlines, break down what's driving the economy and interest rates, and help serious investors make decisions rooted in clarity, not emotion. If you're looking for disciplined, research-driven insight to strengthen your portfolio, you're in the right place.
Welcome to the show, everyone. I'm Bob Barone, and today we are looking at a market that has ballooned to a staggering $2 trillion. I'm talking, of course, about private credit. Josh, when you look at how this is being sold to retail investors and pension funds alike, the big hook is always the same: high, steady yields with absolutely zero volatility.
Right. It's the ultimate marketing dream. They pitch it as this beautiful, smooth ride where the line only goes up and to the right, completely insulated from the daily whipsaws of the public equity and bond markets. But as an advisor who actually manages client money, my immediate reaction to, quote, zero volatility in a high yield environment is what is being swept under the rug.
Exactly. Real markets have volatility. If you are lending money to highly leveraged middle market companies during a period of rising interest rates, those loans are changing in value every single day. The apparent lack of volatility in private credit isn't a structural feature of the asset class. It is an accounting illusion. It is valuation opacity, plain and simple. They are hiding the price discovery.
It's like looking at a house you bought 10 years ago and assuming it's worth exactly what you paid plus a steady 5% every year because you don't have a ticker tape on your front lawn. But just because you don't see the price fluctuate doesn't mean the neighbor's house didn't just sell for 40% less. This claim of superior risk-adjusted returns is built on a foundation of manufactured stability.
That brings us directly to the accounting wizardry that makes this illusion possible. Under ASC 820 in the US and IFRS 13 globally, assets are categorized by how easily you can price them. Level 1 is daily exchange traded prices. Level 2 uses observable inputs like comparable bond yields. But private credit lives almost entirely in level 3. And level 3 is just a polite regulatory term for we make it up.
Marking to model, which we all know quickly becomes marking to myth. In level 3, the valuation is driven by the manager's own internal, unobservable assumptions. They plug their own estimates of discount rates, default probabilities, and recovery rates into a proprietary spreadsheet. Click calculate, and behold, a perfectly stable net asset value.
As a former bank CEO, this terrifies me. In a bank, regulators force you to mark non-performing loans down quickly, and you have independent credit committees looking at hard realities. In private credit, you have the fund manager, who is highly incentivized to keep the valuation high, deciding what the recovery rate will be on a distressed borrower. Trusting a manager's internal spreadsheet to determine fair value when there is no active secondary market is a massive systemic risk.
And if the spreadsheet says the loan is still worth 98 cents on the dollar because of some proprietary quote-unquote workout strategy they've envisioned, then that's what gets reported to the pension fund. It's a closed loop of self-justification.
It gets even worse when you look at how these funds handle secondary market transactions. Let's say Fund A is facing redemptions and has to dump a portfolio of underperforming loans. They sell them to Fund B at 70 cents on the dollar. That 70-cent price is a real hard market transaction. It is the definition of fair value at that moment. But what does Fund B do the very next day?
Oh, this is the classic markup trick. Fund B buys those loans at 70 cents. But instead of marking them at 70 on their books, they immediately revalue them to 90 or 92 cents. They argue that 70 cents was a distressed or forced sale, meaning it wasn't an orderly transaction under ASC 820. So they get to ignore the actual price they paid and use their own model to manufacture an instant 20% paper profit.
It is an incredible loophole. By classifying any transaction that reflects actual credit stress as not orderly, they can completely ignore the market clearing price. It allows them to maintain the fiction of high valuations across their entire portfolio.
But Dad, at the end of the day, my clients can't spend paper markups. If Fund B is reporting a 92-cent valuation, but the underlying borrower can't even cover their interest payments with real cash flow, that markup is phantom wealth. Real wealth is engineered by hard cash distributions, not by accounting technicalities that let you ignore reality.
And here is the kicker, Josh. The managers are getting paid real cash fees on these phantom paper profits. They collect their 1.5% or 2% management fees based on these inflated net asset values. Even worse, they accrue and sometimes actually draw down carried interest, their performance fees, based on these unrealized model-derived valuation markups.
Talk about misaligned incentives. If I can increase my personal compensation simply by tweaking a discount rate in an Excel model from 8% to 7.5%, why on earth would I ever mark an asset down? Weaving a compelling narrative to the auditors about why a failing company will recover turns out to be far more profitable than actually restructuring the debt and taking the hard cash loss.
It is a wealth transfer from the investor to the manager. And while institutional LPs like sovereign wealth funds might have the staff to occasionally peer into those valuation models, the retail investors now piling into these quote unquote interval funds and non-traded business development companies have absolutely no access to these internal assumptions. They are flying completely blind, paying active management fees on modeled outcomes.
They are paying Ferrari level fees for a driver who is just steering a simulator.
This isn't just an issue of investors getting overcharged. It has massive systemic implications. When a private credit fund inflates its NAV, it doesn't just look good on paper. It allows them to borrow more money. They use these paper inflated assets as collateral to secure leverage facilities from major investment banks. So now you have real bank leverage piled on top of fictional model-driven valuations,
which creates a highly combustible feedback loop. If the underlying corporate borrowers start defaulting, the true value of those loans collapses. But because of the valuation lag, the fund doesn't mark them down immediately. When they finally do, the drop in NAV is sudden and catastrophic, potentially triggering margin calls on those leverage facilities and forcing sudden liquidity crunches.
Exactly. And because private credit has grown so large, this opacity distorts the broader credit benchmarks. Regulators looking at the health of the financial system see stable private credit valuations and assume everything is fine, completely missing the buildup of systemic leverage. When the economic cycle finally turns and defaults spike, the losses will be amplified dramatically by this hidden leverage. You would think regulators would be all over this, and to their credit, the SEC tried. In August of 2023, they passed a suite of reforms aimed at forcing private fund advisors to provide more transparency on fees, expenses, and performance metrics. But the industry fought back hard. They sued, and in June of 2024, the Fifth Circuit Court of Appeals completely vacated the SEC's rule?
The court basically ruled that the SEC exceeded its statutory authority. So, with the stroke of a pen, we went right back to the Wild West. That ruling leaves a complete regulatory vacuum. If you are an investor in these funds, you cannot rely on the SEC to protect you or to force these managers to be honest about their valuations.
That is the brutal reality. Institutional protection is gone. If the court says the regulator can't step in, then the burden of due diligence shifts entirely back to the investor.
Which means absolute skepticism is no longer just a good practice. It is a survival requirement. If you are going to play in this space, you have to assume the reported NAV is a highly optimistic, best-case scenario, and you have to do the forensic work yourself.
So let's talk about how to do that forensic work. What are the key red flags investors need to look for when reviewing a private credit fund? First, look at the timing of markups. If you see a sudden, convenient jump in valuations right at quarter end, when the performance fees are calculated, that should immediately trigger your suspicion.
Another big one is extreme return smoothing. If the broader high yield market or leverage loan index is down 10% over a quarter and your private credit fund is reporting a flat or positive return, they aren't geniuses. They are just refusing to write down their assets. Remember the Mirage group collapse, that massive private equity firm in 2018? They were using overvalued assets and borrowing from new investors to pay off old ones, all while reporting stellar, smoothed returns based on fictional valuations.
A classic cautionary tale. The ultimate lesson here is simple. Never buy what you cannot independently verify. Investors must demand sensitivity analyses from these fund managers. Ask them, what happens to this NAV if defaults rise by 3%? What happens if recovery rates are 50% instead of your assumed 80%?
And most importantly, ignore the paper NAV and focus entirely on the actual cash distribution yield. If a fund claims a high return but is constantly deferring cash payments or paying you with, quote, payment in kind, paper instead of hard cash, keep your distance. In the end, cash flow is the only truth in investing. Everything else is just poetry written in an Excel sheet.
Well said, Josh. That's all the time we have for today. We'll see you next time.
Stay safe out there and watch your cash flow.
Thanks for joining Joshua and Robert on Intelligent Investor Insights. If today's discussion raised questions about your portfolio strategy, risk exposure, or how to navigate this late-cycle environment, we invite you to connect with us. We work directly with investors who want data-driven guidance, institutional-level analysis, and a partner in building durable wealth. Reach out to start the conversation with a member of our team, Robert, Joshua, Andrea, Mike, or Eugene, and take the next step toward becoming a more informed, confident, and resilient investor. Until next time, stay rational, stay disciplined, and invest with intelligence.